options like professionals do. So let's continue our journey of exploring options. So in previous episode, we have learned how forwards and futures work. Just to recap, if you think the price of an underlying will go up, you will buy its future. And if you think the price of underlying can go down, you will sell the future. In this episode, we will learn why options were introduced, what are options, how they are different from futures, what is call option, and various scenarios of profit and loss in call options. So let's begin. Introduced. Options were introduced as a hedging instrument. Think of hedging like insurance. When you buy a car, you're afraid of any damage that can happen to it and the cost involved in repairing it. So what do? You buy a car insurance, which will cover any damage that will happen to the car. Similarly, in options, you are afraid that the price of an underlying may go up or down, so you buy either a call option or a put option, which will act as an insurance for your position. Like insurance, an option contract is also an agreement between two parties, buyer and seller. Though options are introduced as a hedging instrument, people also use them for speculation in the market. There are two types of options, the call option and the put option. Everything you can do in this space revolves around these two options. You can make any strategy by making several combinations of buying and selling these two options. Let's understand them one by one. What is a call option? Before we get into call options, let us understand what a future contract is one last time. State Bank of India SBI stock is trading around 500 rupees. You want to buy the stock, you are worried that the price will go up. So you came to me and said, I'll buy SBI next month from you at 500 rupees. And I said, deal. Because you think the price will go up and I think the price will go down, we strike this deal. This is a futures contract. If SBI goes up, you will make profit, and if SBI goes down, I'll make the profit. Whatever the scenario, we both will honor the deal. Fairly simple, right? But after some time, you came to me with another offer and said, I want to buy SBI next month from you at 500 rupees if I feel like doing it. I may or may not buy from you, but if I want to, you have to give me the stock at 500. Let's see in which case you'll buy the shares from me at 500 and in which case you will not. You will buy the shares from me at 500 only when the price is above 500 rupees. In the case the price is less than 500, why will you buy it from me at 500? You will buy it from someone else at a lower price. You can see that in this table. If the price is below 500, you will not buy the SBI shares from me, as you can buy at a cheaper price from the market. And if the price is above 500, then you will buy it from me, because you are getting a share at 500 which is worth more than that. Obviously, I don't like the deal, as you will buy it only when it suits you or when you are making a profit. Basically, loss mera, profit aapka. I was going to refuse the deal, but then I gave it a second thought. So I approached you again with a new perspective saying, hey, I'm protecting you from the risk and insuring you from your losses. You are an option buyer buying an insurance and I am an option seller selling the insurance. As I am protecting you with insurance, I want some compensation. I'll charge some premium, just like LIC, which takes a small premium to insure your life for a huge sum. In this case, I'm charging you a small amount, that is 20 rupees. You might be thinking, why 20 rupees? This is because I think the SBI will not go above 520 till next month. If SBI is trading below 520 till next month, I have no problem. Whether you buy SBI from me or not, the premium is non-refundable and that will be my earning. Now is a good time to introduce you to some jargons. Like in insurance, an option contract is also an agreement between two parties. These two parties are number one, buyer of the contract. You are paying the premium, so you are buyer of option contract. This gives you the right to buy the stock at the agreed price. By right, I mean you can take or leave the deal completely your wish. You have an option to take the deal or not. That's why the term option. When you want to execute the deal, we'll call it you want to exercise your option. Second party is the seller of the contract. I am receiving the premium, so I am the seller of the option contract. And I have the obligation to honor the contract. By obligation, I mean if you want to execute the contract, I can't refuse you. I have to sell the stock at the agreed price. One important point to note, the fundamental difference between futures and option is, in futures, both buyers and the seller have to honor their deal. But in options, the buyer has the option to decide if he wants to do the deal or not. Number 3, strike price. The price at which we strike the deal is the strike price. From our example, 500 is the strike price because you want to buy SBI shares at 500. You strike the deal at strike price. Number 4, expiry. Like futures, here also expiry is the date after which the contract is not valid. From our example, end of next month is the expiry. Number 5, premium. The money you paid me to enter into the contract is the premium. And this is paid at the starting of the deal. Now, let's look at the 3 scenarios of profit and loss. The strike price is 500, the premium paid is 20 rupees. If SBI goes to 510 next month, as an option buyer, you will buy a stock at 500, which you can sell it in the market for 510. You will be making a profit here. But you already paid a premium of 20 rupees. So you are making a net loss of 10 rupees. As an option seller, I have to sell a stock at 500, which is worth of 510 in the market. I'll be making a loss here. But since I have received a premium of 20 rupees, I'll be making a net 10 rupee profit here. If SBI price goes to 520, you will buy a stock at 500, which you can sell in the market for 520. You will make a profit of 20 rupees here, but you already paid a premium of 20 rupees. So you will end up in no profit and no loss condition. As option seller, I have to sell a stock at 500, which is worth 520 in the market. I'll be making a loss here, but since I have received a premium of 20 rupees, I'll also end up in no profit and no loss scenario. If SBI is trading at 530 next month, you will buy a stock at 500, which you can sell in the market for 530. You will make a 30 rupees profit here, but you've already paid a premium of 20 rupees, which makes your net profit 10 rupees. As an option seller, I have to sell a stock at 500, which is worth 530 in the market. I'll make a loss here, but since I have received a premium of 20 rupees, I'll make a net loss of 10 rupees here. By above example, you might have understood 2 things. Number 1, to make a profit on expiry, your stock needs to be above the strike price by more than the premium you paid. Your strike price was 500, premium was 20 rupees. So to make profit, SBI should expire above 520. Number 2, whatever is your profit, that will be my loss, and vice versa. The price where you'll neither make a profit nor loss is called the break-even point. From above example, 520 is our break-even point. The formula for break-even point for a call option is strike price plus premium. Now let's increase the horizon of our imagination. Assume if a stock tanks to, let's say, 400 or 300 rupees, you will be losing only 20 rupees and I'll be gaining only 20 bucks. But stock zooms to, let's say, 700 rupees, then your gain will be 180 rupees and my loss will be 180 rupees. This brings us to the conclusion that the option buyer has a limited loss and unlimited profit potential, and the option seller has a limited profit and unlimited loss risk. That's it for this episode. In the next episode, we will discuss what is a put option and various scenarios of profit and loss in put option. Till then,